We now move on to reading 39 of the CFA curriculum that deals with dividends and share repurchases. So we'll start by understanding what cash dividends are. When and why does a company do stock dividends and stock splits? Understand the dividend payment chronology. Understand the concept of share repurchases. And wind up by understanding the difference or the impact of a share repurchase versus a cash dividend. So cash dividends are generally of three types. Regular dividends are paid by the company every quarter or every 6 months or every year. So companies normally do not like to miss their regular dividend payments, and it is considered fairly negative if a company misses out on its regular dividend payment. Special dividends are paid if the company has a windfall gain or a high one-time gain from the sale of an asset or for some opportunity or from any manner. So these are not regular, but they are also given or announced often from time to time. Liquidating dividends are given when the firm is winding up operations or is liquidating all its assets. So it's returning all the money to its shareholders, and the amounts remaining after all the debt holders, employees, liabilities have been paid is returned to the shareholders as a liquidating dividend. In stock dividends, as we studied in understanding the income statements, companies don't give any cash amount. Rather, for every shareholder, they give some additional shares of the company. So a 10% stock dividend implies that somebody who's owning 100 shares of the company will get an additional 10 shares. We proved in that review, and we will prove again, that stock dividends and stock splits, as we'll see next, have no economic impact. They simply increase the number of shares. They don't increase the market value of the company. So John Black owns 100 shares of Walter Company at a current price of $40 per share. Walter has 1 million shares of stock outstanding, and its earnings per share for last year were $2. Walter declares a 15% stock dividend to all shareholders of record as of July 1st. What is the effect of the stock dividend on the market price of the stock? And what is the impact of the dividend on Black's ownership position in the company? Now, 15% stock dividend implies that somebody who was earlier owning 100 shares of the company will now own 115 shares. That is additional 15%. Do you think the sales of the company on account of this announcement will also instantly go up by 15% or will go up by 15%? No? Or do you think the customer base will increase by 15%? Or any economic operation or business of the firm will change because of the announcement of the stock dividend or whatever extent it may be? It won't. So economically speaking, nothing changes in the company, apart from the fact that if earlier a given amount of shares were outstanding, now more will be outstanding. So earlier Walter Company had 1 million shares outstanding, and the price of each share was $40. So the total value of the company earlier was $40 million. That is, if I wanted to purchase all equity of this company, I could have simply paid $40 million and bought all the shares, theoretically speaking, assuming there was infinite liquidity in the market. This fact does not change whether there is a stock split or stock dividend. The total worth of the company will not change because of a stock dividend, because economically, as we understood, nothing has changed. So now we know there's 1.15 million shares outstanding because of this 15% stock dividend. The total worth of the company cannot change because economically nothing has changed. Hence, the new stock price will be slightly lower, or it will be to the extent of 40 upon 1.15. So the stock price will instantly react downwards and come down to a value of $34.78. Now, guys, that solves the first part of the question. That is, what will be the new market price of the stock? Second part asks that what is the impact of the dividend on Black's ownership position in the company? Earlier, Black owned 100 shares out of a total of 1 million shares. So Black's ownership position was to the tune of 1 upon 10,000. So this is the amount of the company that was owned by Black earlier because of his 100 shares. Now Black has how many shares? He has more than 100. He has 115 shares because he's been given a 15% stock dividend. Everybody has been. However, because everybody else has also been given this stock dividend, the total outstanding shares will also not be 1 million, it will be 1.15 million units outstanding. So Black's ownership position remains the same after the stock dividend. So as we understood earlier, the total value of his holding will also remain the same. Earlier, the value of his holding was $40 and 100 shares, that is $4,000. Now it will be $34.78, but 115 shares still going to be $4,000. So economically speaking, nothing changes. The number of shares goes up, and hence all per share parameters will come down. So earnings per share will come down, stock price per share will come down. We can summarize the impact of the stock dividend. Number of shares go up. Earnings per share earlier were $2. Now the per share earnings will go down to 1.74 as more shares are outstanding. 1.15 million shares are outstanding. The stock price will go down to 34.78. Total market value will remain the same. Black's number of shares will go up to 115 from 100 earlier. However, the value of his ownership remains the same, and his ownership stake in the company remains the same as 0.01%. Now again, remember guys, that a stock split is theoretically equivalent to a stock dividend. So if I say a 3-for-2 stock split, what it implies is that for every 2 shares of the stock outstanding earlier, you will now have 3 shares. Or you can say that a 3-for-2 stock split is the same as a 50% stock dividend. Even if this company had announced a 50% stock dividend, if I had 2 shares earlier, I would get 50% as dividend, that is another 1 share as stock dividend, or the total number of shares that I would have is 3. So 3-for-2 stock split is the same as a 50% stock dividend. So economically, stock dividends and stock splits can be looked at in the same way, or you can say every stock split can be written in some form as a stock dividend. So Walter Company declares a 3-for-2 stock split this time. The current stock price is 40, earnings last year were 2, and the dividends were $0.7 per share. And there are 1 million shares outstanding. So similar information as last time. What is the impact on Walter's shares outstanding, stock price, EPS, dividends per share, dividend yield, price to earnings, and market value? Just for the sake of understanding and repetition, we'll do it once more time, but we know that the concept is going to be exactly similar. So shares outstanding will go up by 50%. As for every 2 shares, there are now 3 shares. So if earlier 1 million were outstanding, now there will be 1.5 million shares outstanding. That solves the first part of the question. As far as the stock price is concerned, the total market value of the company will not change. So earlier it was 1 million into $40. Now also the market value will be the same, that is $40 million, or 1.5 million into X dollars per share. And we can compute the X as 40 divided by 1.5. So the stock price immediately on this announcement or immediately on the execution of this stock split would come down to $26.67 per share. That's the second part. The earnings per share similarly will come down, as earlier the earnings were $2 per share or $2 million net income. With 1 million shares, a $2 EPS would be $2 million of net income. So the earnings per share now would be $2 million. Again, that is the net income divided by the number of shares, which has gone up to 1.5 million. So it will be 2 upon 1.5, that is $1.33 per share. The dividend per share was earlier $0.7 per share, would now move down again. So we will first compute the total dividends upon the total number of shares. So total dividends would remain the same. That is 0.7 into 1 million number of shares, or $0.7 million. But the number of shares has now gone up to 1.5 million shares. So this will come out to be 0.7 upon 1.5, that is $0.467 per share. The dividend yield is calculated as the dividend per share divided by the stock price. So please note that in the new scenario, the dividend per share has come down. However, the stock price has also come down. So the earlier dividend yield was simply 0.7 divided by 40. That is a number of 1.75%. The dividend per share now has come down to $0.467, and the stock price has come down to $26.67. So please verify that the dividend yield will remain the same as earlier, that is equal to 1.75%. Similarly, the price to earnings multiple earlier was $40 divided by $2, that is 20 times. And the new price to earnings would be $26.67, that is the stock price, divided by 1.33, that is the new earnings per share, that is the same as 20 times. So price to earnings, market value, as we've discussed, will remain the same after a stock split or a stock dividend. Please verify your answers. Companies sometimes do a reverse stock split, or you can think of it as a stock merger. So a 1-for-2 stock split would be a stock merger. That is, for 2 stocks earlier, now there will be only 1 stock. Again, this will have the exact opposite impact, that is no economic impact, but it will increase the stock price or double the stock price and reduce the number of shares. The question is that if stock splits and stock dividends really have no economic significance, why do companies do them? The reason often is that firms want to keep the absolute stock price per share, or the price of one share, within an optimal trading range, which in the US we've seen is about $20 to $80 per share. Please note that if companies like Microsoft, Google, Infosys had never done a stock split in their lives, the value of one share would have been in hundreds of thousands of dollars. So companies often do stock splits to bring the absolute stock price down. As we just understood in our example, the stock price went down to $26.67 earlier. So that an individual or retail investor can easily purchase the stock. It enhances liquidity, it makes your investor base more broad-based, and it is good for general trading in the market. So that's the reason why companies give stock dividends or do stock splits. Empirically, these arguments may not have a lot of theoretical backing, but empirically, the following is what we have noticed. That stock prices tend to rise after a stock split or a stock dividend. That is, the market takes the stock split as a positive signal that the management is expecting very high earnings or it's expecting very high stock prices. That is why it is doing a stock split to bring the stock price down. So it is taken as a positive signal. However, if positive news flows do not follow a stock split, that is, a good earnings announcement or some other such news does not follow, then the prices revert back to their split adjusted levels. That is, then this positive bias that was there tends to get removed if positive news does not follow. That's just what we've empirically seen. Conclusion remains that stock splits and dividends create more number of shares but don't increase shareholder wealth. And rightfully so as well. If doing stock splits or dividends could increase shareholder wealth, companies would stop doing business and they would only do stock splits and stock dividends. Doing good business, having good customers, having good products is what increases shareholder value, not stock splits or dividends. So guys, the payment of cash dividend follows the following chronology. That is, the company first gives us a declaration date. So the declaration date is the date that the board of directors decide that they want to pay a dividend. So this is normally the same date as the quarterly results or the annual results of the company are announced, and along with the results, the board declares a dividend. So in this example, August 25 is when the board has declared the dividend, and almost simultaneously, the company fixes something called as the holder of record date. That is, all individuals or corporates holding the stock on this day will be paid the dividend. So shareholding of the company can change every day. People buy shares and sell shares of a stock every day on the exchange. So some people may own it, others may not own it tomorrow. So how do we decide who should be paid the dividend? It is decided as per the holder of record date. So anybody holding the stock here gets the dividend. The knowledge of the holder of record date will automatically allow us to calculate the ex-dividend date. That is normally 2 business days before the holder of record date. If you purchase the stock on the ex-dividend date, that is on or after the ex-dividend date, you will not get the dividend. Because in most markets globally, there is a 2+2 settlement cycle. So if you buy it today, then the stock actually will come to you on September 18th. So once the stock has gone ex-dividend, or this is where the stock price will start reflecting the payment of the dividend. From here on, the stock will trade as though the dividend has already been paid. The actual payment date is the date when the checks are emailed or the amount is electronically transferred to the shareholder's bank account. So just to revise guys, declaration date is the date the board of directors approves the payment of the dividend. Ex-dividend is the first day a share trades without the dividend. That is, if you buy the share on or after the ex-dividend date, you will not receive the dividend. Holder of record date is the date on which the shareholders of record, so whoever is owning the stock here, will get the dividend. And on which day? The exact date is the payment date when the checks are emailed or when the payment is electronically transferred to the shareholder accounts. Instead of paying dividends, which often tend to become a necessary, that is, if you've paid a dividend in 1 year and then you see that you're discontinuing the dividend or you're not paying in the next year, it is taken as a negative sign. Hence, to return money back to shareholders, companies often adopt another method that is called a share repurchase. So share repurchase is simply the company buying back its own stock from the market. We'll study in more detail the signaling effect and the consequences of share repurchases at level 2. But please understand that if the management uses the money to buy back its own stock, it definitely is a positive signal, as the management is indicating that my own stock is a good investment at the current price. So I would like to buy it back and invest in my own company rather than any other company or any other project. And as the number of shares goes down, So we'll understand the exact impact with an example very soon. However, understand how a share repurchase can be executed. You can simply go and buy it in the open market over an exchange through a broker like any other investor buying the stock. However, if quantities are large and there's a big number of shares that you're buying back, this may not be a very efficient technique. So, a lot of times companies give a tender offer. That is, they just advertise that we are going to buy back 100 shares to the whole world, they announce at a price of $100. This price normally would be higher than the current market price, and whichever shareholder feels that it's a fair price for the stock that he's willing to accept can tender his or her shares to the company. That's another way of trying to get back or buy back the shares. And finally, companies can directly negotiate with some large shareholder or one large investor and fix a price and purchase the shares from him. That's called repurchase by direct negotiation. Either ways, the impact is the same. The company buys back some shares, pays some of its cash out, and extinguishes the shares or reduces the number of shares outstanding. So let's see the impact of a share repurchase on the earnings per share of the company. So Abbott Pharmaceuticals plans to borrow $48 million that it will use to repurchase the shares. So company is borrowing money to buy back equity, or it's taking on debt to retire equity. Abbott's CFO has compiled the following information. The share price at the time of buyback is $60. The shares outstanding are $25 million. The earnings per share is $6 per share, and the earnings yield, that is the earnings per share upon the stock price per share, can be calculated as $6 upon $60, that is 10%. The after tax cost of borrowing is 20%. Would the before tax cost have been higher or lower? Please note that interest gives us a tax shield. So before tax would be greater than the after tax cost of borrowing. With $48 million and $60 per share, how many shares would the company be able to buy back? $60 we need to pay for one share. So for $48 million, that is 48 into 10 to the power $6, and at a price of $60 per share, we'd be able to buy back 800,000 shares or 0.8 million shares. So company plans a buyback of 0.8 million shares. Calculate the EPS after the buyback. So the EPS before the buyback would be calculated as the net income divided by the number of shares outstanding. The net income would be the EPS multiplied by the number of shares, that is $6 is the EPS multiplied by the number of shares of 25 million. So $6 into 25 million would be the absolute net income for the company before the buyback. The absolute number of shares is 25 million. So dividing the two was giving us an earlier EPS of $6 per share. If the company does this buyback or executes the buyback, then 800,000 shares will get extinguished. That is, from an earlier amount of 25 million, there would now only be 24.2 million shares outstanding, as 0.8 million shares have been bought back and extinguished. However, the cost of buying back these shares was financed by issuing new debt, and that debt will come with a corresponding interest liability. So the total amount borrowed is $48 million. That can be calculated as $60 into 0.8 million shares, or the amount that the company borrowed to do the buyback. So we borrowed $48 million at a cost of borrowing of 20%. So 48 into 0.2 would have to be deducted as the after tax cost of debt or the interest cost from my net income. So this will be the impact on the numerator. The net income goes down and following will be the impact of the denominator, that is the number of shares go down, and this calculation will give us the new earnings per share as $5.8 per share. So we see that the earnings per share has gone down from $6 to $5.8. The reason why this happened was because the after tax cost of borrowing was higher than the earnings yield of 10%. So we are borrowing at 20% and investing at 10%, thus creating a net loss or reducing the EPS. In a similar example, if we calculate when the after tax cost of borrowing is lower than the earnings yield, everything else remaining the same, then we will see that the EPS will move up to $6.02. Please verify this calculation. Everything else remains the same, just the cost of borrowing is not 20% anymore, it is 9%. Similarly, let's try to calculate the impact of a share repurchase on the book value per share. Please remember, book value per share is also known as the net worth or the shareholders' equity. So the share prices of Alpha Company and Beta Company are both $30 per share, and each company has 30 million shares outstanding. Both companies have announced a $15 million stock buyback. That is, they will spend $15 million to repurchase their own shares, Alpha as well as Beta. Alpha Company has a book value of $400 million, while Beta Company has a book value of $950 million. Calculate the book value per share of each company after the share repurchase. So let's first do it for Alpha Company and we'll similarly do it for Beta Company. So for Alpha Company, the existing book value is $400 million and we have repurchased $15 million worth of stock. So the earlier book value per share can be calculated as 400 divided by the number of shares, that is 30 million, that is $13.33. For the new book value, we will use the new number of shares. So for $15 million at a stock price of $30 per share, how many shares would we be able to buy back? So $15 million upon $30, that is 0.5 million shares. So if earlier there were 30 million shares outstanding, now there would be 29.5, that is 30 minus 0.5 million shares outstanding. If earlier the company had an absolute book value of $400 million, then now we have retired $15 million, or $15 million we have given back to shareholders. So this amount will come down by $15 million, or the new book value per share would be 385 million divided by 29.5 million. That comes out to be $13.05, which is less than the 13.33 that we computed earlier. So please note that if the current stock price is higher than the existing book value per share, so we see as $30 is greater than 13.33, that is the existing book value per share, then doing a buyback will reduce this book value per share. If the existing stock price or the current market price is lower than the current book value per share, then doing a buyback would increase the book value per share, as we will study from the example of Beta Company. So Beta Company has a current book value of 950. So the earlier book value for Beta can be calculated as 950 divided by 30 million shares as $31.66. Now this $31.66, that is the current book value per share, is greater than $30, that is the current stock price or the current market price. So if we now compute the new book value per share, we will see that for beta company, again of the 950, 15 million has been returned, or the numerator will come down by 15 million, the book will reduce. And from the earlier 30 million shares outstanding at a price of $30 per share, with $15 million, I will again be able to buy back 15 by 30, that is 0.5 million shares. So the number of shares will come down from 30 million shares earlier to 30 minus zero point 0.5, that is 29.5. Or the new book value per share for beta company will come out to be 935 divided by 29.5, that is equal to $31.69. So once again, remember, if the current book value is lesser than the stock price, then a buyback will reduce the book value per share. If current book value is higher than the stock price, then a buyback will increase the book value per share from 31.66 to 31.69, as we just saw in the case of beta company. So please verify the calculations once. Finally, we'll understand the very important concept of analyzing a share repurchase vis-a-vis a cash dividend of equal amounts. As we introduced, we studied that both are ways of returning wealth to the shareholders. Buying back or extinguishing your stock and reducing the outstanding number of shares, or paying back cash as dividends, both eventually reduce the equity and give money back to the shareholders either by way of capital appreciation or by cash. So if Abbott Pharmaceuticals has 25 million shares outstanding with a current market value of $55 per share, and Abbott made $150 million in profits for the recent quarter. So if Abbott Pharmaceuticals has 25 million shares outstanding with a current market price of $55 per share, and the company made $150 million in profits for the recent quarter, only 70% will be reinvested back into the business, and remaining 30% can be repaid back to the shareholders. The board is considering two alternatives for distributing the remaining 30% to shareholders. First is to pay a cash dividend of $45 million, that is 30% of 150. On 25 million shares, this will be $1.8 per share. And the second alternative is to repurchase $45 million worth of common stock. How would the wealth of an Abbott shareholder be affected by the board's decision on the method of distribution? So currently, the stock price is $55 per share, or the worth of every Abbott shareholder for every one share is $55. If the company pays a cash dividend of $45 million, then in the case of the cash dividend, each shareholder will get $1.8 in cash. However, if the earlier worth of the company was $55 per share into 25 million shares, now this worth will be reduced by $45 million, or to the extent that the company has paid dividend. The number of shares is still 25 million. So the new stock price can be calculated as 55 into 25 minus 45 upon 25. That is $53.2. So what we see is that the total wealth of the shareholder actually does not change. Even without any dividend, the stock price was $55 a share. And with this dividend, I have $1.8 in cash. However, the stock price has gone down to a value of $53.2. So my total wealth remains the same as $55. However, 1.8 is in cash with me now, and $53.2 is in the stock. So from an economic perspective, nothing has changed, because even earlier I could have sold this stock if I needed the money and gotten $55. Even now, if I sell the stock, I will still have $55 in cash. 1.8, that is a dividend that has already been paid, and another 53.2 that I'll get from selling the stock. So we see that a cash dividend does not increase or decrease shareholder wealth, it remains the same. Let's see if the share repurchase does anything different. So if we repurchase $45 million worth of common stock, then the number of shares will reduce. If the stock price per share is $55, then for $45 million, how many million shares will I be able to buy? 45 million divided by 55. That is 0.8181 million shares. So the new stock price per share will be calculated based on this new number of shares. However, again, from the total market value earlier, that is $55 per share into 25 million shares, that was the total market cap of the company earlier, or the total market value earlier, $45 million have been taken away. They have been taken away and given to the shareholders from whom we have repurchased the shares. So this $45 million is not with the company anymore. So just like in the case of the dividend, even in the case of the share repurchase, this $45 million have to be decreased from the value of the company since this cash is no longer there. However, the number of shares have also been reduced. So whatever is this remaining value is now distributed over a lesser number of shares because we've repurchased and extinguished some shares. So if earlier we had 25 million shares outstanding, we now have 25 minus 0.818181 number of shares, or the new stock price will come out to be $55. So we again see that the share repurchase also does not change the total shareholder wealth, which was $55 earlier and still continues to remain at $55. So please remember that doing a share repurchase or giving a dividend may have some signaling effect. Details we'll study at level 2. But theoretically, they cannot alter shareholder wealth. If the company could alter shareholder wealth by doing repurchase or having a dividend policy, then companies would stop doing business and just pay dividends or do share repurchases. So to increase or decrease shareholder wealth, once again, the business has to improve, the performance has to improve, the cash flows need to improve. Doing share repurchases or paying out dividends is not going to increase total shareholder wealth. Doesn't mean you shouldn't pay dividend. So we'll study the advanced concepts and theories of dividends in more detail in the coming levels. That was the introduction and the basics of share repurchases and dividends. Please verify your answer and make sure that you're comfortable and you can easily do all these calculations. Practice a lot of questions from the question bank, and see you next time.